Well, welcome. My name is Dean Tenney. Uh, Thank you for your participation in our YouTube channel. I'm coming to you from my studio here in fabulous Las Vegas. And this is for Series 65, 66 candidates. This is the first lecture explication that I've struggled with whether to broadcast it or publish it. And here is why. This is 50 questions. I'm not calling this a practice exam for lots of reasons. It's not. At some future date, I plan on doing a practice exam on the investment component of 65, 66, and a separate practice exam on the regulatory side of the 65 and 66. And that's not this. This is a very narrow part of the exam. I've always recommended, and I recommend it still, and you probably should do it before you watch this, that you print out the test specifications. And these 50 questions are on a very narrow part of those test specifications, concepts like time value of money, modern portfolio theory, liquidity and solvency ratios, those kind of things. And, when people miss the mark on 65, 66, they don't blow it completely. They blow it by a very small amount. So I'm hoping that maybe with this explication, you can be a little more comfortable with those concepts. But, I won't be disappointed if this doesn't get a large viewership. I was, talking to a candidate who I told I was going to go ahead and publish this, even though it's been in reserve for a while. And with the disclosure that unlike the actual test, which is a balance of easy and difficult questions, these are some of the most difficult concepts you could expect on your exam. So, it's a buffet. Take what you like, leave what you don't. And if you feel like you're comfortable, then by all means, go ahead and participate in these 50 practice questions. As always in explications, if you want to try them yourself, you simply hit the pause button, you answer, then you hit resume, and you can see, how you did. I also recommend in all these lectures that you keep a notepad and maybe 3x5 or 4x6 cards, because, flashcards are very, very underrated as a study tool. And for recognition style test questions, flashcard is pretty decent. I believe in making your own, by the way. People tell me they bought some, they find them on Quizlet. I think that kind of defeats the purpose of you on your own creating your flashcards. I joke you can use those to your own study effort, but you could also use that flashcards if you make flashcards to get rid of people, significant others who are bothering you while you're studying. You say, "Hey, honey, can you run the flashcards with me?" And maybe they'll say, "Ooh, I didn't realize this was so serious." All right, let's get started. Okay, so an investment advisor representative, that will be you, calculates $10,000 invested today. Let me get my annotations tool fired up here. Will be $20,000 at some future date. And so what did you do? You did which of the following? You did B, the future value. Now, again, I decided in this 50 practice questions not to get into the math. There's a couple times I'm going to do some math with you, but it's not so much can you do the math, it's do you recognize the math? And there's two reasons I didn't do the math in these 50 questions, show you the math. One, I'm thinking if, you can give me some feedback if you want, I think there should maybe a separate lecture on the math. But again, I'm torn about whether that would be a productive thing for you, because more often than not, people that say, "Dean, I didn't have to do any math," or one or two calculations. They were very simple. Makes sense because you have a simple function calculator, not a financial calculator. And so that just makes kind of sense that would be the case. But, let me know your thoughts on that, and I'd be more than happy to do that. By the way, very much like the test as well, all of these answers are right answers to different questions. So they're pretty good at distractors. Distractors are the technical name for wrong answers, and they're really good at wrong answers that sound good, right? So you go, "Oh man, I know that's something. It ain't this though. It ain't this," is the point. All right, let's try another one. As an investment advisor representative, you need to calculate how much need to be invested today for a future's client investment objective. That might be college, it might be retirement, whatever that investment objective is. So now you're going to go from calculating how much needs to be to futures today, right? You need to calculate how much needs to be invested today to get to your objective. So now we're going the other way, right? Well, let me get my annotation tool out. And so now we're going from here back to here to come up to see what that number is. right? And that would be not a future value, that'd be a present value. We need to figure out how much money we need today, how much you got and how much we need. An investment advisor representative, your client, needs $25,000 in 12 years. You assume a 6% rate of return means your client needs to invest today $12,500. To figure that out, what calculation did you use? Well, once again, you used what? You used the present value calculation, right? Again, just trying to get you comfortable with, what you're being asked to recognize in terms of the test question, right? The calculation you performed was present value. And again, as I said, you're not going to have to calculate any of these formulas: present value, future value, internal rate of return, net present value. You have to recognize the math. Well, what would you do if I asked you to do it? And then, questions like these, fly high, strategic kind of level questions. If you want, send me in the comment box or, email or however you want to do it. If you'd like me to show you the math and and I'm more than happy to do so. But by choice have decided that that's not a productive use of our 50 practice questions. The annual rate of regrowth that an investment is expected to generate can best be described as, boy, a lot of people are interested in what's called the internal rate of return. Oh, sorry about that. Tell you what, I'll use my PowerPoint one. That seems to work a little better. The internal rate of return. By the way, this would not perhaps be a bad idea for a poor man's flashcard, where you just, you get rid of the wrong answers and then you just read the questions and the right answers. That might not be a bad way to go. I like this one. People say to me they've seen this a couple times. Bonds yield to maturity or basis reflects which of the following. So, when you buy a bond at a discount or a premium, what you're interested in, remember, is that yield to maturity, also known as the basis. So bonds yield to maturity or basis reflects, it doesn't reflect the present value. I mean, we could, figure out the net present value by doing a discounted cash flow. That's not what they're asking. They're just asking, what is your internal rate of return? I say, your yield to maturity on this bond, you buy it, I'll just make up a number, you buy it at 90, it has an 8% coupon. Your yield to maturity basis is 9.5%. So that's 9.5% you're expecting annually in terms of the return. You don't have to do any kind of a yield to maturity calculation either. Just again, showing you how these questions get asked. This is basically the same question, just said differently. So which of the following reflects a bond's internal rate of return? Now, by the way, test taking trick, you could get rid of these two right out of the gate, because those are intellectually the same thing, and they can't both intellectually be the same thing and both be right answers, right? The bond's nominal yield and the coupon rate are one and the same. So by that alone, you could get it to a 50-50. Current yield. No, current yield doesn't reflect, remember, the internal rate of return. The current yield is simply what the bond pays you divided by what it costs you. You're certainly going to have to do current yield on the test, but that's not this question. That, again, is going to be yield to maturity. So listen, on these questions that on Debrief people tell me they've seen, you're not going to see all three of these, but I just try to give you different versions of that same question. So, like I say, in all these 50 practice questions, there's maybe 7 or 8 potential performance opportunities on them. We just don't know what they are. And so, I'm just trying to give you different versions. So this is really not a 50 question set of practice questions. It's really 7 or 8 testable issues on 65, 66. An investor uses an expected rate of return of 10% on their initial investment to fund a college education, but the actual return was 8. So we didn't do what we thought, right? So the future value calculation I used this, and that's what we were assuming we were going to get. Now we got that. And so that means we're going to have a little bit of a problem, right? We're going to have a lot less money than we thought. An investment advisor representative has calculated the value today of a future set of dividend or interest payments. Now, in this question, I didn't say a future set of cash flows, because that would have given it away that it's this answer. So I'm trying to camouflage in this question that it's a discounted cash flow analysis. And so let me just clean up the slide here. So an investment advisor rep has calculated the value of a future set of dividends. So I'm looking at the stock. Mr. Buffett is a big fan of this, right? He owns 1 billion shares of Bank of America. Bank of America pays him 70 cents in annual dividends. The assumption is, perhaps, there's 2 assumptions. Mr. Buffett can do this discounted cash flow analysis and figure out, okay, well, what would I be willing to pay for this future set of dividends I'm going to get from Bank of America. That's called discounted cash flow analysis, right? Or if it's bond, I'm going to say, okay, what is the discounted cash flow of the interest payments I'm receiving, these semi-annual interest payments I'm receiving on the bond. Now, by the way, test taking trick, you could have also used, and don't give up on your test taking tricks. We've got a whole lecture on test taking tricks. And you could have said, well, I know it ain't that, because I know fundamental analysis has to do with the company, the industry, the balance sheet. I know it ain't that, because that's got to do with support and resistance and, head and shoulders patterns and things like that. And by process of elimination, you could have got down that. Maybe you know this, maybe you don't. That's insurance, right? And so you could have used process of elimination. An investment advisor representative has calculated the value today of a future set of dividends. So now I'm actually telling you that we're looking at a stock that pays dividends. We're looking at a stock that pays dividends. So she assumes the dividend will remain constant. So when she's doing her analysis, she's assuming that the Bank of America dividend is going to remain at 72 cents. It's not going to be more than that. And so that's going to be by the way, now we're getting a little more specific. She's doing that, but she's applying it to this. And so she's doing the dividend discount model, right? Now, if she assumed that the dividend could grow, she'd be using this version. And then a test question would be something about, well, what would help justify a higher price for the stock, right? In Mr. Buffett's analysis, if he can say, well, I think that Bank of America is going to be raising its dividend. I mean, it's 72 cents today, but I would assume that they can grow it. And if that's the case, it would justify a higher price. So, this would justify a higher valuation on the stock if we're doing that. And obviously we can't do this analysis if, the stock doesn't have a dividend. So the answer to this one is B. And this is basically the same question again. An investment advisor representative has calculated the value today, future set of dividends. By the way, 50-50 based on that. Dividends, right? She assumes the dividend will grow over time. Boom. That's this version, right? Again, I'm not going to make you do a dividend discount model on your exam, thank God, right? I'm just asking you to recognize the type of analysis that some people use in terms of, some of the math that people are using. And as I said, the other thing I'd be aware of on your exam is that this would justify paying a higher price for the stock. An investment advisor representative has determined the net present value of a bond is $940. So I did that discounted cash flow analysis on the interest payments I'm receiving. And I decided, well, gee, the number that makes sense for that math is $940. Now, again, this is a good example of where you don't need to do the math. I mean, you could just say, well, gee, I think the best value is the lower price. Boom, I'm done. But, based on my net present value, I'd be overpaying for those two numbers, because why would I want to pay more than my math tells me the bond is worth in terms of its future interest payments? And then these two are a good deal. But, given that these two are a good deal, this would be the better deal. That would be the better deal. Again, another example where I'm not asking you to calculate net present value. I'm just telling you what it is. And then based on that, asking what would be the better value. Would you find this attractive? No. Would you find that attractive? By the way, I could let me reverse this question. I could say an investment advisor representative has determined the net present value of a bond is $940. Which of the following prices would represent the least value or overpaid, and you'd come up with that one, right? So, listen, this comes up on the test. So, when I teach Series 7, when I teach SIE, when I teach, 65, and even you sevens who are taking your 66 can suffer from what I call a little bit of hubris. And, you go down there and you say, hey, I just took a test on all these, investment vehicles. I'm pretty good to go. And, that hubris can cause you to miss things, because there are things that are unique to the 66 and the 65. I think of the 65 as a baby 7 that you don't encounter on other exams. So, if you were with me and we were going over this, I'd say, in fact, I just had a candidate today that I was chatting with. He's studying over the weekend. Kudos to you weekend warriors, man. Shout out to you. I mean, that's tough, trying to carve out the time when you got work and family and other things. The business model for a lot of folks is 4 months with pay to pass tests. That isn't a lot of folks anymore. But anyways, when I am there, I say, listen, even if you don't receive working capital on your 7 or, balance sheet questions on your 7, you're certainly going to receive them in your 65, 66. And so, working capital shows up quite a bit on the exam. So listen, of these, niche kind of areas of 65, 66, I told you this whole 50 question practice set that we're looking at is based on a very narrow part of the exam, which is quantitative analysis and fundamental analysis. And, I said 7, 8 questions. You can print out the PDF, put a check mark in terms of your intellectual inventory as we do these questions. But you should certainly know working capital. I would not want you to be taking a 65, 66, or a 7 for that matter, without knowing working capital, which is current assets minus current liabilities. I would definitely be able to do that. Now, that being said, I would also know these other ones. Now, working capital is about a company's liquidity. This is about liquidity. The liquidity is short term, right? This is about liquidity. And this is about solvency, long-term debt. Here we're worried about, can the corporation pay its short-term obligations? Here we're worried about, can the corporation pay its long-term liabilities? So we're going to slow down here a little bit because all of these are going to be very testable. So working capital, by the way, I always stress too, it's testable at 2 levels, particularly working capital. It's also the balance sheet, because that's where we get this from. The balance sheet is a picture in time of a company's financial situation, right? And we also need to be able to have a kind of recognize how this plays out for my client too, their working capital, whatever their current ratio may be. All right, so that one's working capital. I don't know if you're like, I had a guy, I like this. What he did is he printed out, he snippet some of these slides, and then he printed them out. He did that in the margin lecture, and I thought that was a very smart thing to do. And then he just filled in the things. Here, what I'm saying is perhaps on these things I tell you are good poor man's flashcards. If you've been with me a while, you probably know what a poor man's flashcard is. If you haven't been with me a while, or have never been with me, let me tell you what a poor man's flashcard. A poor man's flashcard is I simply don't have time to make flashcards. And so I simply just, take my, let me get my black here. I take my highlighter, let me get rid of that. And I get rid of the wrong answers. And then what I'm doing is just reading the question and the right answers when I'm studying, right? So now if you printed this out of slide companies, their current assets, a good flashcard is kind of what I'm hinting at. You might want to do that. Let's talk about some of these others. Now, by the way, if I told you that this is in the same category as discounted cash flow and net present value and internal rates of return and future value, and I told you the balance sheet was a couple of them, I also would want to get these because if I am struggling with some of that, higher quantitative stuff, this is simple arithmetic or division. And so that's easier to do, easier to master. Okay, so again, we talked about whether you have a dream draw or a face of death draw, whatever kind of draw you have. And on a really bad draw of the exam, they might ask, what's the effect on a company's working capital? Well, if the board of directors declares a dividend, it becomes a current liability. So if the current liabilities go up, it would cause the working capital to go down. Now, test taking advice, again, the advice is a buffet. There's people that differ. And so sometimes one of the challenges you have is too many different voices in your head. And so, you got to decide what voice to hear. So I know there are people who have different ideas and different suggestions for you than Dean. I understand that. For example, I don't believe that you should go back and review a bunch of questions just because you have time. I think your flash response is your best response, and you shouldn't be changing answers. You should only change an answer if you know you got it wrong. You know what the right answer is, by all means, change it. That's what good test takers do. And if we're not a good test taker, we're trying to emulate becoming a good test taker. I know there's different advice, but I would tell you what another advice is: don't ever take the cannot be determined choice. That's hardly ever, I can't think when I would ever take a cannot determined as one of my answers on the exam. Because the point is, as an investment advisor representative, you can't tell clients you can't figure out. I can say, well, listen, I don't have the resources right now to figure this out, but we have somebody who can. So shy away from that cannot be determined answer. Okay, working capital pays the dividend. Now, again, this is kind of being a jerky one too. I mean, if we, I'll just make up some numbers here. If we had $40 million in working capital or current assets, Current assets are cash or things we plan to turn to cash within 12 months. And we had $10 million in current liabilities. The working capital would be $30 million. And if we declared $200,000 in dividends, as I just showed you on the previous slide, I'm just illustrating, you're not going to have to do this math. I'm just illustrating that indeed the working capital decreases. But now if I pay that dividend, so I just cut the checks, I'm the CFO and I cut the checks, my current assets go down, but so does my current liabilities. And so kind of a trick here, there's no effect on working capital when the company pays the dividend. I kind of think it's like your own personal situation, right? You know, paying your bills, sitting down with your checkbook, if you're one of those old people who have a checkbook, paying your bills doesn't affect your working capital. You have less of an asset called cash, and you have less of a liability when you pay the bills, right? There's no effect on your working capital. So kind of a trick question, right? They declare the dividend, it goes down. They pay the dividend, it has no effect. I'd be doing you a favor on your exam to cover every key but the division key. If you can't decide what to do, hit the divide key. And if you can't remember what to divide, take the first number and divide it by the second number. That takes care of, 90% of math on your exam. Now, we just talked about what working capital is, and it's not that. The current ratio is the current liabilities, current assets divided by the current liabilities. Just recently, I just told you we had a company with $40 million in current assets. I'm just making up the numbers to illustrate this. And so we found out that that was 30 million in working capital. And so our current ratio is 4 to 1. We have $4 in current assets for every liability we have. Again, you're not going to get all of these about liquidity and solvency, but again, on feedback people give me on their exam, I'm just trying to come up with all the kind of different versions where these ratios could come into play. And so, this is about liquidity. Which of the ratio is not associated with liquidity or solvency? That's a PE ratio. Now, the reason I came up with this slide is I wanted to test you on a PE ratio without giving it to you, right? I could have made a question like, what is a company's price divided by its earnings? And that would make this very, very easy. But what I'm trying to do here is two things. I'm trying to test you on, do you know what a PE ratio is, price divided by earnings? That's very testable. There's no draw in which you're not going to get asked about that. But also, if you knew that, then you'd say, well, no, a price to earnings ratio isn't about a company's liquidity. It's not about its solvency. It's just simply the number of years it takes me in earnings to get back what I paid in price. And I use that as a comparison, whether I think the company's overvalued or undervalued to other things. So this is really a question about recognizing the PE ratio as not being associated with liquidity and solvency. We haven't done this one yet, but that is, and that one is, right? So kind of a roundabout way of testing you on that. So now I'm actually giving you a corporation. I'm telling you the corporation has current assets. I don't know what that is. It's on my slide or my slide deck, it looks like. Anyways, current assets of 40 million, inventory of 20 million. So listen, we don't want to have an inventory reduction sale. We don't want to have an inventory reduction sale. And so the quick assets of a corporation are the current assets without the inventory, less the inventory. It makes sense because if we have to sell inventory to pay our bills, we're not going to get the margin we're expecting, right? If I have to put the closeout rack out there and, sell this because I can't pay my bills, I've got to turn my inventory into cash quickly. I'm not going to get the price I want. So we're saying, well, what are your quick assets? What are your quick assets? Well, my quick assets then would be 20 million, right? The quick assets are the current assets without the inventory. Now, I doubt you'll see this on your exam, but we do have the quick ratio. And again, if you don't know the quick assets, you can't do the quick ratio because that's where we're heading. The quick or asset test, a more stringent idea of liquidity, a more stringent idea of liquidity. So the current assets less the inventory, the current assets less the inventory. Let me get a different color here. We said that's called the quick assets. That's what that is. And again, what I'm trying to avoid here in the question is giving away what that is, right? Making you actually kind of know that. It's a more stringent. It's also called the acid test ratio. So we just recently did that. It was 20 million. Now we're not going to divide by, 20 million, 40 million. We're going to take that. We're going to divide by our current liabilities. We're going to come up with 2 to 1. Quick or acid test. By the way, this ratio, you won't get all this, but you're definitely going to get this answer set. So, I had a person on the YouTube channel, very loyal subscriber, and he said, I kind of like your very important answer sets. So maybe one day I'll just make a slide deck with answer sets and no questions, and maybe we'll explicate it that way by going through and saying, what would the answer be if it was this, right? So, well, we just did that one, right? Now, I think it's more a recognition than having to do it, but we just did this one, and we said it was 20 million in quick assets, right? 40 million minus the inventory. That's our quick assets. And then we divide that by our current liabilities. And then remember, you don't have to be watching me. You could stop before I, stop the thing, try it, and then, turn the thing back on and see how you did. So 2-1. This is me kind of being a jerk. As I told you, I hesitated to, I've had these 50 questions ready to go and been thinking about whether to publish or not. And one of the reasons I decided, not to publish earlier is because, again, this is very difficult stuff. And, your real exam is going to give you a balance of easy and difficult questions. And I further told you that these 50 questions represent, a handful of potential performance opportunities. So I'm not so sure how much in the weeds you want to get. And you probably shouldn't be getting in the weeds on this stuff unless you already got everything else under control. But that being said, I want to make sure that you understand the difference in these things, right? Here we're concerned with the company's liquidity, and liquidity is always short term. So when we're talking about a company's liquidity or even a customer's liquidity, we're talking about short term things, right? This is liquidity. This is liquidity. Liquidity is, cash, or things you can turn to cash quickly. And then we said this one is about solvency, and that's about your long-term liabilities. Can you pay off your long-term debt, right? That's more about, can you pay your mortgage for the next 30 years? This stuff isn't about what you can pay in the next, 30 years. This is, right? So I gave you 2 versions of this answer set, by the way. I gave you this one. I gave you, let's see if the next slide is the one. Let's see. Nope. I gave you I'll show it to you again. Same answer set again, but without the except. All right, so here we go. This is something I would know again. This is testable. So as we're going through this, I'm telling you, listen, there's not a whole lot of questions here, but we don't know what they are, so we have to cover it. And so, here, the company's total capitalization is the long-term debt and shareholder equity, the net worth of the corporation. That's how much money is involved in running this business. And so we have $50 million worth of debt, and we have $40 million in shareholder equity. And so the total capitalization of this corporation is $90 million. Now, a couple things about this. If you want to compete with this corporation and have the same financial resources they have, you're going to need $90 million. Sometimes that can become a competitive issue. And then, how much of that is debt versus how much is equity? Again, that could be a solvency. I joked about Toys R Us. Toys R Us filed Chapter 7, not Chapter 11. Chapter 11 would be more about reorganizing your short-term liquidity problems so you could get back to conducting business. So Chapter 7, not testable, by the way. Chapter 7 is complete liquidation. Ultimately, we decided that Toys R Us is not solvent. They don't have any solvency, and so they decided to liquidate the business, sell off the assets. Now, I would tell you that selling toys is difficult. Selling toys against the competition like Walmart and Amazon is very, very difficult, but it doesn't help that they got billions of dollars in debt on the balance sheet and they can't service the interest on the debt. That is a contributing factor besides the idea of, selling toys, right? if we did forensic accounting, we might find out it wasn't the toy business that did them in, it was the debt that they had on the balance sheet. So here's an example of this. So now we're going to figure out of that money, that's the bond money, that doesn't belong to the shareholders, that belongs to the creditors. What that means is that 55 cents of every dollar does not belong to the owners in this corporation. 55 cents of every dollar we have in capital belongs to our bondholders. Now, again, we use that again about this idea about solvency, right? I'll use hotels. I'm familiar with financing hotels, and hotels that have no mortgage need 35% occupancy to break even. Hotels that have a mortgage need 85% occupancy to break even. So, if you own a hotel and I own a hotel, let's say those hotels, for all intents and purposes, are kind of the same. They're on opposite sides of the street, and we get into a pricing war. I'm going to win because, I don't have any debt and you do, right? So again, we're concerned here in this calculation about solvency. Sears is another example, right? Sears, like Toys R Us, it's difficult. Like Toys R Us, Sears is trying to sell their products and services in competition with, Amazon and Walmart. But again, they have a lot of debt on the balance sheet. It becomes an issue. And again, Chapter 7, they're not solvent. Walmart certainly is. Walmart's got plenty of, equity, a little bit of debt. And so, a little more, they have to sell less stuff is the point, less stuff. And then we go, so, right, these are liquidity and that's solvency. Again, I would admit that a little overkill in terms of what you need, but that's, what we're trying to do here. This is kind of counterintuitive. A corporation that has a high percentage of long-term debt, a small percentage of equity, is said to trade on equity. So, here's our balance sheet. Here's assets on this side. We have our current assets. We have our long-term assets. And then over here, we have our current liabilities. We have our long-term liabilities. And then we have this equity. And if this equity is just a little slice of this, right? Let me get a different color highlighter. Here's our capitalization again, our debt and our equity, our total cap. And if we just have a little bit of that, then we're saying trade on equity. Utilities trade on equity. What that means is utilities have a huge amount of debt and a small amount of equity, right? So again, depends on your draw. That is a fair game on the test. Whether you see it on your particular draw, who knows? Who knows? A corporation's board of directors decides to inform shareholders that the dividend policy will be a dividend payout ratio of 50%. So again, what I'm testing you on is this dividend payout ratio without actually telling you what it is, because I want to make you do it without telling you the formula, right? A lot of the performance opportunities do have, there's, you're in Series 65, 66 fantasy land. You pass your exam, you get to move on. Yours truly, I'm stuck here permanently. No wonder I'm demented. But, on the actual real world, there are examples of this. And I saw the board tell its shareholders, listen, you're expecting us to pay out all of our earnings as a dividend. And, we want to keep some of it in retained earnings so that we can build the business. So, moving forward, we're telling you that the board, when we meet, is going to look at the earnings per share, and whatever the earnings per share are, you as a, shareholder could expect a 50% dividend. So that number is going to be fluctuating. Unlike Bank of America, which just says it's 16 cents a quarter, which is 74 cents a year until further notice. And I thought this kind of been interesting. So now the board, we just concluded the earnings, we got $2. So our shareholders are going to expect us to pay $1, right? So we're paying out $1 of $2. The dividend payout ratio is 50%. Now we would expect mature, stable businesses are going to have a higher dividend payout ratio than, growth companies. We don't expect a growth company to pay us anything in dividends, right? I mean, the only two ways we're making money in a corporation, or any investment for that matter, is income stream and or price appreciation. So if there's no income stream, then again, it would be, price appreciation, right? So the board is telling us we could expect that. Now, that's not typical, by the way. So this is a question I made up to test you on dividend payout ratio without being really forthcoming with it. So, I told you, I'm trying to be a jerk, Dean is trying to stretch your mind, hope it doesn't go back to the same spot. And you can, these will be more routine as you bump into them in your practice questions. And most importantly, when you take your 65, 66. Again, so higher math, I'm not going to make you do this again. I'm just going to make you recognize it. So determining the volatility of a security based on the security's past returns is, you should be able to get rid of this right away, because you should know that beta is compared to the market, and there's nothing in this question about the market. So you should have been able to eliminate beta. You should know alpha has to do with the market. So you should have been able to eliminate that, right? The Sharpe ratio, maybe not, but you could get it to a 50-50, and a 50-50 is always important. That's standard deviation. Now, again, it's not so much this particular question, it's this answer set. Now, again, in this 50 question practice set, I'm not going to go into calculating beta or alpha or Sharpe or standard deviation, either because, actually both reasons. I'm thinking a future lecture I might, if I get enough requests for it and people say, Dean, I swear I had to do that math. I wouldn't, until I get confirmation by enough feedback, I would say, I don't really believe that. Maybe once you had to do some math. And if you do, I'd like you to be operating from abundance and not scarcity. And what I mean by that is I'd like you to be able to kind of guess B and say, move on. By the way, you might want to consider a poor man's flashcard. So, maybe you want to print the screen, or if you got your slide deck out. And let's get let's see, let's get that out of there. And you might want to turn this, let me get it bigger. Right? And maybe you turn this into a poor man's flashcard. Here we go. So again, I'm not asking you to do the math. I'm asking you to recognize the math. So a measurement of stock or fund's volatility as compared to the market as a whole can best be described as, that is very much a test question. I can't imagine any draw. Sometimes they just say beta, not beta coefficient, but that's very testable. So a beta of 2, would be twice as volatile as the underlying market, right? So market goes up 10%. Usually the S&P 500, I would expect it to go up twice as much. So the market goes up 10, I expect 20. By the way, works in both directions. So the market comes down, works both ways. Alpha, right? These are, again, it's not this question. It's this answer set. Right here, a return. Oh, my bad. Let's go back. Dean Dean blew it. I was looking for the question that wasn't there, right? So that's the beta, right? By the way, here we should have been able to get rid of the standard deviation, because right here it says as compared to the market, and we should know that that's not the market. That's the historical returns of that particular security and the dispersal of those returns and how likely it is to be within a certain band. So we should be able to eliminate that. So chance for Dean to redeem himself. Again, I think it's a good poor man's flashcard. There's no draw in which you're not going to get beta. Now, if I really thought I was a great money manager, I'd say, well, listen, why should you pay me based on beta? Right? Maybe you should pay me on alpha. Again, the idea here is not to calculate it, but alpha is that return in excess of beta. Again, you're not going to have to calculate it. If I get enough feedback, maybe I'll do a couple beta calculations in a future broadcast or lecture. But this is alpha, right? So alpha, beta. A portfolio's excess return relative to the risk-free rate of return divided by the standard deviation. Woo! Again, I'm not asking you to do this. I'm asking you to recognize it. By the way, once they say this, because, well, it can't be that one, right? Because, it's just telling me I'm going to divide that number. So that's not the answer. I should be able to eliminate this, because again, I'm looking here, risk-free to return divided by standard deviation of the portfolio. That's not that. It's not that. Again, what I'm trying to do is maximize my return. I'm trying to come up with a portfolio where I maximize my return by minimizing my risk. And the higher the Sharpe ratio, according to, Math Geeks and Modern Portfolio Theory and Capital Asset Pricing Model, the better I'm doing in that function. So I say to you as a money manager, I say, well, listen, my Sharpe ratio looks like we're equal, but if you do our Sharpe ratio, you'll find out My Sharpe ratio is 1.5. The higher the Sharpe ratio, the better in terms of doing what we did in the previous slide. The better I'm doing at getting the excess return without taking all the risk. Again, it's not can you do the math, it's can you recognize it. There is no draw in which you're not going to look at an answer set that looks like this idea of correlation. So stocks in two companies in a very similar industry, Coke, Pepsi, Boeing, Airbus, Ford, GM. They're likely to have positive correlation, meaning they both move in the same direction. So again, if I'm a portfolio practitioner, and I'm trying to diversify your portfolio, why would I buy you, if I've already got Ford in your portfolio, why would I buy GM? That doesn't make any sense. I get better diversification by trying to find something that has negative correlation, right? So positive correlation means things move in the same direction. And negative correlation means they mean in opposite directions. By the way, this is more likely the scenario on the test, is this idea that I want to have something in the portfolio that goes the other direction. I said that I just gave you an illustration of that. Just trying to give you all the, again, permutations of this kind of thing that you could expect to see. There we go. Guaranteed test question. I don't know of any exam 65, 66 draw in which you at least don't get a question about negative correlation. And, we see it on the exam in the positive light, that if I'm trying to diversify your portfolio and I got stock A, as we mentioned, I'm not going to get stock B that goes the same direction. I'm going to get stock C that maybe goes in a different direction. In terms of math, I could figure out, how much correlation there is to that. And maybe my idea is that, Ford sells cars, but if people don't buy the cars, they break down, they're going to buy car parts. And so I buy a part company or something like that. No discernible pattern. Perfect correlation, man. Very rarely you get perfect correlation. I've told this story a couple times about perfect correlation. And here was the example of perfect correlation that I was so upset. And, mainly because of a Platonic ideal of the perfect correlation. But, I had a doctor client, we bought the stock. I think we bought it at like 94 and the stock went to like 180. Woo. And I called the doctor and I said, hey, listen, doctor, why don't we buy a 175 put? Why don't we buy a 175 put contract? And at the time, I think that was like $3. And we would have been out 98. Anytime he wanted, he could sell at 175. He would have a guaranteed profit. Listen, here's what I was upset about, and see if you understand this conversation with him. He didn't do it. And as the stock went down, the stock went below 175. So here's our strike price on our put at 175. And as the market goes down from there, for example, when the stock is at 170, I say, doctor, for every dollar you would be losing on the stock, you'd be making it up on the intrinsic value of the put contract. This put contract is now worth 5 points. There would be perfect correlation, meaning every drop below 175, whatever dollar amount he lost in the stock would be offset by the gain in the value of his put. Wow. That's the thing I was most upset about, is that we lost an opportunity for perfect correlation. Now, again, you're not going to have to do this thing I brought up here in terms of Dean's war story, but yeah, you very rarely are you going to get perfect correlation, right? And here, what I hint about here is for every dollar lost, gains a dollar, right? That's a perfect correlation. Now, we're going to try and get close by doing some math. I said, well, listen, I don't get perfect correlation here, perfect, positive or negative, but I can get close, and as the math, I would try and get as close as I possibly could. Anyways, that's why I was upset. Very rarely, I told him, I said, doctor, very rarely do we get a hedge, in terms of, an asset like this where we're going to have perfect correlation. It's going to be close, but it's not going to be, perfect. You're going to have to do the simple average on the test. And so the mean is just a simple average. You're going to have to do that a couple times. I'm going to show it to you a couple times in various different forms. And again, I don't know if you want to do a flashcard here again. Remember, these 50 practice questions we're doing are not really, 50 questions you're going to encounter on the investment component of the 65-66. No, it's 50 questions on a very narrow part of the 65-66 that people do struggle with. And so we're trying to, hope that it's less of a struggle. We're hoping that, it becomes less of a foreign language rather than more. I'm going to show you a couple versions of calculating a simple average. The middle number in the sequence is the median, right? You can think of the median on the road, right? That's the middle of the road, right? I'm going to show that to you. The mode, so let me just get my thing out there. Which represents more often, that's the mode. And lowest to highest is the range. So that's just recognition. Again, it's not, I don't know which of those you're going to get, but you're going to get that answer set. As I said, you are going to have to calculate an average. I don't know, what average you're going to have to calculate, but you're going to have to calculate an average of something, and so we want to be able to do that. Again, it's division. As we said, everything is division. All right, so here's the historical performance of a mutual fund over the past 4 years. So here's our sequence of numbers. We have 10, -4, 8. We have 3. So here's all our numbers, right? Now I've taken the liberty of writing those numbers down, right? So you get, an official sheet of scratch paper. So I might recommend that you take your official sheet of scratch paper and, write down the numbers. When I do all these numbers, 10, 16, 26, 29 minus 4, I get 25. If I add up all those numbers, I get 25. And then I simply take 25 divided by the number of occurrences, and I get a 5. So, what is the mean? That's the simple average, 5%. All right, so what we did is we added up all the numbers, 10, 26, 29 minus 4 is 25. And we got that 5 is our mean, or simple average. You're going to have to do that. All right, what's the mode? So now the mode, remember, is the number that occurs most often, right? The number that occurs most often, and that was 8%. What is the range? Well, if we go here on the range, here's our -4, and here is $10, or 10%, excuse me, -4% and a positive 10%. I kind of think of this like a thermometer, right? If I'm in Minnesota, with my friends in Minnesota, oh my God, it gets cold. And if it's 4 degrees below zero, 4 degrees below zero, and my Minnesotan friends say, hey, Dean, it's warming up. It's now 10 degrees. What was the total movement, the total range? The total movement from -4% to 10% is 14, right? By the way, I shouldn't, let's see. Oh, let's see. Boom. There we go. 14. Here's another example of a simple average. Here's another example of a simple average. You're going to have to do that. I told you, if you can't remember what to do on your exam, divide. If you can't decide what to divide, take the first number divided by the second number. But here I got several numbers here, right? So I'm investing $100 every quarter. By the way, this is very testable. This is an example of dollar cost averaging. This is an example of dollar cost averaging. Okay, so I've invested $400 over this, quarter, $100 a quarter. So $400 is my investments thus far. Let's see. And it says the public offering price. So the public net here. So now I say, okay, well, now we get the sequence of numbers again. And that's 30. Right now, be careful. This I don't need for this particular question. Now I'm just being asked, what is this, right? So I'm going to divide that by 4, and I find out the average price was $7.50. right? They're not asking me about this. They're just asking me what is the average price. Now there's two versions of this dollar cost averaging in terms of a simple average. For the first one is what makes dollar cost averaging work, fixed dollars invested regularly. And then what's the end result? Now we do need this, right? So we paid $400 and now we got to figure out how many shares we got, right? So we had $100 that we invested. And so now what I'm being asked to do is figure this out. So my first was made 10. So if the public offering price is $10, I got 10 shares. And now the public offering price is $5. And so I got 20 shares. P.S. I'm doing exactly what I should be doing, is buying less shares when they're high and more shares when they're low. That's exactly what I should be doing, right? And then it's 10. I get 10 shares. And then it's back to 5. And I get 20 shares. And so now 400 divided by, let's see, I got 20, 30, 50. I got 60 shares there. And I think that that's going to be 666, but where's my calculator? Let's just be clear that it is. 400 divided by 60 shares. Indeed, 6666. By the way, that's the end result. That is the end result of dollar cost averaging. You end up with a lower average cost than that of the underlying shares. So again, I'm just showing you here that you're going to have to do a simple average, right? So we did this simple average, the mean. We did it a couple times. We did it for that fund. We found out our fund, it was 5. And then we did it again for the average share price. And then we did it again for the average cost. So just 3 different versions of that. Client expresses, this is very much a test question. So there are a couple questions in this deck that I just, are there. I mean, so I guess I told you I'm not worried if you didn't watch this presentation, but if it was 1 or 2 points you got out of the presentation and that made the difference, well, then it becomes material, right? Anyways, client expresses his belief in the efficient market hypothesis. There's 3 versions of this: weak, strong, and semi-strong. Who cares? But he's saying that he doesn't believe in active management, right? Everything to be known is known. And this is very much a suitability question on the exam. Why are you going to pay the guy, right? My friends at T. Rowe Price to do that. You wouldn't do that. You wouldn't do that. You could do this by process of elimination. So very much a test question. Which of the following theories about how risk-averse investors can construct portfolios to maximize their expected return based on a given level of risk? Wow. Theory isn't truth, just a way of explaining things. And the more a theory can explain, the better that theory is, right? And this is the whole point. Oh, there's where that dot is coming from. I was trying to figure out where that dot's coming from. This theory is called modern portfolio theory. Now, I joke when these guys blow up, they blow big. But again, that's very much a good poor man's flashcard. That is something, I would make a flashcard, or, if you're like the guy who was telling me that what he does on the channel is he snippets things and then, he uses them as flashcards. Very much a test question. I'm not going to ask you to get a PhD in modern portfolio theory to pass the 65-66. I'm going to ask you to have a general understanding of that. By the way, you maybe could have done this by process of elimination. I'm not sure if you could, but maybe some of you know what this is. Maybe some of you know what that is. So maybe you can do it that way. You 7s are probably going to be in better shape in terms of process of elimination than perhaps our 65s. P.S. Just, I don't know if you're aware of this, but the 63 and 65 existed before there was a 66. And, people were getting 7s and taking 63s and 65s. Broker dealers said, this is ridiculous. There's so much overlap. And so, FINRA said, okay, if you have a 7, you can take a 66. So that's the basic difference, right? 66 assumes you have a 7. You can't just take a 66 and have it work if you don't have a 7. It's kind of a combo deal, if you will. A 65 would work independently of having a FINRA registration. Fee-based, person would have a 65 and they may not have a 663. And then we have people who have 663s or 763s. They circle back with a 65. Which of the following best describes the relationship between systematic risk and expected return for assets? Now, again, even if you're not good at this stuff, you can still know, well, it's not this because I know what that is. It's not this because I know what that is, right? It's not this because all of these are kind of similar, right? So it's got to be this one. Again, another good poor man's flashcard. I'm not asking you to do any math here. I'm just asking, again, recognition, to recognize that. So again, very much a test question, very much a good flashcard question. It may or may not show up on your exam. It just depends. Now, the last thing I have on here, and I haven't figured it, listen, I won't have my feelings hurt at all. I'm being totally sincere. If you did not find this helpful, please let me know, because me too. I'm not sure it is or not. I've been sitting on it a while, but I'm going to put it out there, right? And it's a buffet. And, if enough people say, Dean, I didn't find it productive at all, then I'll hit the delete key and, it'll disappear from the channel. But I'm also trying to find a way to come up with an organized way to share debrief questions. So these last two questions are just bonus debrief questions, and I put them in the deck. And so again, maybe you get a question right based on that. It makes it worthwhile. But these come from a couple test takers. And so you can really expect something similar to these last two questions, which I put in here that I'm calling bonus debrief for lack of imagination. Questions, I call them sometimes questions from the front. Again, I'd be interested in your thoughts. I do a quarterly report. Some people don't like the quarterly report on the channel, but I like to give you a quarterly report. I'm thinking maybe I add into that a quarterly debrief where, I just make a bunch of slides and once a quarter go through the, things people tell me they've seen. I don't know, a way to share debrief with you. But this candidate worked really, really hard. I wish he deserves a score. It would have been a very, very high score because he really executed his study plan well. And he said he missed this one. And when we talked about it, he missed this one. And I've had several reports of a question similar to this. Anyways, here we go. A customer purchases a $100,000 S&P 500 index with a 60% participation rate and a 5% cap rate. What does that mean in English? That means that the insurance company is going to credit you for 60% of the S&P, but in no circumstance are they going to credit you for more than 5. So the first thing I'm going to do is I'm going to take the 100,000 times the 11%, and we find out that would be 111. But remember, they said they're only going to give you 60% of that. So now I'm going to take, let me get my slide there. I'm going to take the 11,000 times the 60%. 0.60 is 60%. And when I do that, let's see, 11,000 times 60% is 6,600. Now, here's kind of what he blew. He said, well, it's that. I said, but no, there's a 5% cap rate. So after this first year, it's going to be 105 after year 1. Again, how did I do that? I took the 11,000, 11% of that is 11,000 times the 60. And they said, no, you don't get that. You get, no more than 5. So that's 105. Now, the trick on this one and why he missed it is there's never going to be a negative return. You can't lose your principal. And that's why some state administrators consider this to be an insurance product and not a securities product, because you're not going backwards from 105. So the next year it falls 11. And so you started with the 105 again, right? Because you don't go backwards. And that's what he missed in this. Remember what I tell you about that choice? Don't ever take that cannot be determined choice. Here's another bonus debrief question. Another bonus debrief question that shows up a lot. It really has nothing to do with what I've been doing in these 50 questions for the Series 65, but I'm trying to pass them on to you. So this shows up a lot. That's a qualified domestic relations order. And I haven't had anybody with a 65, 66 draw that hasn't seen that. So both of those questions are high probability. Most of the questions we went through in today's session were low probability. What I mean by low probability is you may not see them. You're going to see some mix of them. I would think on the high side 8, on the low side 6 of the 50 kind of questions we went through are something you could see. We just don't know what they are. And so we spent a lot of time on a very narrow part of 65, 66. But I've had people who tell me that this narrow part of the exam sometimes can be the difference in making the mark or not. And hence, broadcasting, publishing this lecture. All right, so let's talk about the future. In the future, I plan on doing a properly weighted practice exam on the investment component of 65, 66. I also plan on doing a properly weighted practice exam on the regulatory component of 65, 66. So that will be in the future, and it won't be just one of these narrow-based things. It'll be a full-blown explicated practice final like we've done for the Series 7 and that playlist. If you've been with me for your Series 7, we did it in the SIE. We'll do something like that. So that'll be in the future. No promises about when we do that. I try and publish something every 2 or 3 weeks. I'm trying to keep up with the people who are matriculating. And so we do have some test takers who are taking their 65, 66. And I wanted to get at least some more stuff up there for them. So anyways, thank you very much. Like, share, subscribe to the channel, tell your friends, and I'll probably have something up there about what's after this one. This will premiere Thursday. This is Monday, Tuesday, probably the 23rd or 24th of April.